Hey everyone, welcome to the KE Report and another daily editorial here on March 11th. We are chatting with Jeff Christian, managing partner at the CPM Group. Going to be focusing again on the precious metals because those are what are continuing to move, almost in a way diverging from the broad averages, which in all fairness, we are seeing market weakness across the board. Yesterday on Monday, the metals were following the markets down, and today a very different story. The metals are responding, and I think even more encouragingly, the precious metal stocks are responding today, moving higher in the face of more market weakness. So, Jeff, I wanted to ask you one question regarding central bank buying of gold. It's been a pretty important theme for a number of years now, really dating back, I believe, about a decade when central banks really started purchasing gold. However, recently I've noticed a couple articles saying central banks haven't been purchasing as much gold. They've been winding down some of their purchases. Jeff, you do a lot of research in this area. What are you seeing? What are central banks doing when it comes to the buying side of gold?
Yeah, I'll start by telling you that in 2024, central banks on a net basis bought less than half as much gold as they did in 2023. 2023 central banks bought about 18 million ounces of gold on a gross basis and about 14 million ounces on a net basis. Some central banks bought 18 million ounces, others sold 4 million ounces. The balance was net additions to central banks of 14 million ounces. Last year, some central banks bought about 10.5 million ounces, others sold a couple million ounces, and the balance was about 8.4 million ounces. So roughly half as much gold bought on a net basis in 2024 as 2023. But I want to point out a couple things. And one is that 2023 was a high level of growth and net purchases. And the other thing is to understand it, you have to understand, I mean, central banks are primarily involved in supplying the money supply to keep inflation as low as possible and economic activity as strong as possible without stimulating inflation. And in most countries last year, central banks were very busy because they saw weaker economic activity, higher inflation, and they were struggling with their economic environment, which is their primary job. Additionally, because they had weaker economic activity and higher inflation, their currencies, by and large, were falling. So they were dealing with trying to support their currencies at the same time they were trying to support their economies. Gold kind of took a back seat. But the other thing to remember is that central banks don't think, I want to buy X ounces of gold. They think, I want X dollars of my monetary reserves in gold. Now, the gold price was like $1,950 in 2023. It was like $2,395 last year. So the same amount of money that you say, I want to move this amount of money into gold, the same amount buys less gold. So part of what you saw with the reduction in gross and net central bank purchases last year was the fact that gold prices were 24% higher, 23% higher. So, the same amount of money buys less gold. That was one of the factors. The other one was, hey, the gold price is high, and I'd rather buy low than buy high. And then the fact that the central banks were sort of preoccupied with their domestic economic issues and currency issues.
Well, Jeff, did you notice any trends with any specific central banks? Who were the biggest buyers? Were there any that were sellers? Maybe any that stand out to you?
Yeah, there were, and there are some significant things. I mean, one thing you have to pay attention to is since 2022, the Russian central bank has been using its gold to support the government, to finance the government and the war effort. So if you look at Russian central bank holdings of gold, what you see is a very volatile situation where they've been buying 1 month in the domestic market and then selling it in the international market to raise foreign exchange. And Russian central bank purchases and sales have been very volatile since early 2022. that kind of masks the bigger trends with all the other central banks. That's one thing to watch out for. And, we've been paying attention to it because, interestingly, in November and again in January, the Russian central bank sold a whole lot of gold. They sold 1.6 million ounces of gold in January alone. And you can see, November, December, January, the Russian central bank was clearly running low on foreign exchange and money to support the war effort. And it was really in bad shape. Its total gold reserves had fallen by the end of January below 74 million ounces. They reversed that in February and they bought an enormous amount. They bought, like, I think, more than 3 million ounces of gold in February, taking their total reserves back up to 77 million ounces. So that Russian activity is very important. The other thing to pay attention to is the largest net buyer last year was the Central Bank of Poland. And Poland actually has been buying a lot of gold since early 2022. When Russia invaded Ukraine, Poland complained that was not a good thing to do. And Putin said, parts of Poland used to be parts of the Russian Empire too, so you ought to just shut up. And the Polish central bank started buying gold. And importantly, a lot of the gold they've been buying in for delivery in New York. That's one of the reasons why the arbitrage between London and New York has risen, is because you had, last year alone, the Polish central bank bought 2.9 million ounces of gold. But in the period from, say, 2022 to through last year, they went from 9 million ounces to more than 15 million ounces in total reserves. So they bought about 6.2 million ounces of gold over the last 3 years. Interestingly enough, the amount of gold held by foreign central banks at the New York Fed has risen about 6.2 million ounces at the same period of time. And we've seen that gold physically moving into the New York Fed. So the Polish central bank and some other central banks are saying, we want to have our gold reserves as far away from Russia as possible. And so those are two of the big trends to specific countries that we've seen over the last 14 months.
So, Jeff, I'm also curious if we look at what else is on the central bank balance sheet, especially the US dollar. Are we seeing central banks sell their US dollars to buy this gold, or are they selling something else to buy this gold?
They've been selling euros. The dollar holdings as a percentage of foreign exchange held by central banks, the dollar holdings have held up in this 58 to 62% of foreign exchange range pretty well. There has been the use of dollars to support the economies and to pay for it, because the dollar's value has risen over this time. But they have used dollars, but mostly what they've gotten rid of are the euro holdings by central banks as a percentage of foreign exchange has gone from like 29% to around 19% over the last 10 years or so. So there's been a movement actually away from the euro. And, you keep hearing gold promoters and demagogues talk about how people are moving away from the dollar and central banks are moving away from the dollar, but that's not true. Central bank dollar holdings have held up pretty well, unchanged. And if you look at it in terms of treasury holdings, U.S. Treasury holdings by overseas entities or offshore holdings of Treasury securities rose 10.5% in 2023 and another 7.9% in 2024. And they're at record levels. They were $8 trillion at the end of 2023. They were around $10 trillion by the end of 2024. So, we keep hearing in the gold market that central banks are dumping the dollar and they're dumping the treasury securities. But in fact, the exact opposite's been happening.
Yeah, it is interesting. It seems like it's other currencies that maybe they're selling to buy the gold. So we also saw the highest annual average last year in 2024 compared to prior years. And while central banks make up a lot of that, how does the rest of investment demand factor in, Jeff? And what trends do you see for 2025 shaping up?
Well, that's the big thing that we're looking at, and yeah, you saw investors buying very little gold like back in 2018, 2019. Net investment demand back then was about 16, 17 million ounces a year in those 2 years. And then, with 2020, it popped up to 40 million ounces because of COVID and the worldwide lockdown. It came back down to about 25, 20, 25 million ounces a year in the years 2021 through 2023. Last year, it shot back up to about 38 million ounces. And, we're projecting that it probably goes over 40 million ounces this year and next year. So you're seeing private investors continue to buy gold, even at the higher prices. And that jives with the historical performance. Central banks tend to be value investors, and private investors tend to chase the price higher. So when private investors want to buy 38 or 40 million ounces of gold, they push the price higher. When the price goes higher, the central banks say, if private investors think that gold's worth, $2,800, I'm going to stand aside. And if the price comes back down to something below 2,700, I'd probably be an aggressive buyer. So you've seen that dynamic last year in spades with a big increase, from 22 million ounces to 38 million ounces of private gold investment on a net basis, physical gold, and then a sharp reduction, like more than 50% in central bank buying.
Jeff, what about CoT reports? Let's talk about these commitment of trader reports, especially considering the last, let's say, month and a half, where gold has really established itself above, let's say, $2,800. It had a short-term pullback, didn't even get to that round $2,800 level, and then has just more or less levitated right around 2,900, give or take, let's say $50 on either side of that. You noticed anything in the CoT reports in terms of open interest, shorts, who's even shorting the precious metals? What's going on more of that investment demand side of things?
Yeah. Well, what we've seen is an increase of gross holdings and net holdings by institutional investors, commodity funds, hedge funds, and other institutional investors, larger non-commercial positions have risen. They're not as high as they were in 2020 during COVID, but gross holdings, gross long positions are more than 35 million ounces. If you go back 2 years ago, they were closer to 25 million ounces. And the other thing you've seen is a reduction of shorts. So again, 2 years ago, shorts had maybe 15 million ounces of gross short positions that institutional investors had, and it's around 5 million ounces now. So very few institutional investors who get involved in the futures market want to trade it from the short side. In fact, the short volume's a third of what it was 2 years ago. And the long volume is, it's up, I guess, about 40% from 2 years ago. So you're seeing shorter term futures oriented investors, institutional and individual investors, buying a lot more gold futures and options.
Jeff, how does silver contrast to gold? And sometimes it's a much different market. Do you see any different patterns on the commitment of traders reports for silver?
Let me just grab them. Hold on a second. Central banks don't get involved in silver. It's not a monetary metal, it's a financial asset only. I shouldn't say only. But what we've seen is a much more muted long position on silver. So institutional investors, non-commercials, have increased their long position, but not as dynamically as with gold. They haven't gone as high as gold, and they haven't gotten anywhere near where they were like in 2016, 2017, and again in 2020. But there's been a big decline in the short position. So again, institutional investors don't want to be short silver, but they're more reluctant to be long gold, or they're more reluctant to be long silver than they are long gold. So, and that jives, that's in the futures and options market, but it jives with what we're seeing in the physical market and with ETFs and with coins. There's a much greater attention on gold right now than on silver.
If we look back in history, then more than just, let's say, the last decade, but let's go 50, 60, 70 years, whatever you can go back for us here, Jeff. Does this time correspond to any other time in history where we are seeing gold breaking out? More interest in gold, also in silver, but to a lesser extent. And I guess countries diversifying away from other currencies to buy gold.
Yeah, I mean, the big time that we saw was 1978 into 1980, which was, a period of economic activity, but with much higher inflation. You have to pay attention to the fact that the economic environment and economic and financial market regulations were radically different, much more strict regulations back then. The dollar had been floating less than a decade. So currency, fluctuating currency markets was something new that banks and investors and others were trying to deal with. You also had more than half of the investable funds in the United States and elsewhere in the world managed by their owners as opposed to managed by professional money managers. By the late 80s, early 1990s, you had more people saying, I'm going to give my investable funds to a professional money manager to manage rather than try to make these decisions myself. So it was a radically different time, but I would say the late 70s, which was leading into that deep double dip recession from 1980 through 1982, that is probably the most similar to where we are today. You have some things that are specifically similar to, say, 2001 when we had a recession. We had the tech stock blow up and investors lost like $5 trillion in internet stocks that were hollow shells. There was nothing there. You had a similar situation 2005 to 2009 with the housing market and the collateralized mortgage obligations, where investors lost about $7 trillion. So you've got some similarities to those previous periods leading up to a recession and then going into a recession. But probably the closest thing that we've seen is 1978 to 1980. And before that, you have to go back to the late 30s with the rise of fascism, communism, Nazism, dictatorial powers, and the Great Depression and the march toward war. So, there's a lot of similarities to the late 30s, unfortunately, in the present economic and political environment. But if you just take the post-war period, it'd be 78 to 80.
Well, Jeff, just in light of all the uncertainty that the markets are facing, we've been seeing the general markets, at least in the U.S., starting to correct over the last couple of weeks, and gold has been pretty resilient. Now, there's two camps of people out there. One group that believes if the general markets roll over, that people will sell their gold if it's up and, rotate it into stocks as they sell down. The other group is actually looking for a divergence to take place where precious metals will get the bid as the safe haven while the markets are correcting. What way do you think it's going to play out?
I think both views are actually accurate. Which one wins is hard to say. Traditionally or typically or historically, what you see is that if you see a major downdraft in equities and bonds prices, you'll see liquidation of gold and silver as people race to cash. And then once the immediate hit is over, then you see them go back into gold and silver before they go back into stocks. So you could see gold and silver fall in the event of a major decline in stocks and bond prices. But gold and silver would be expected to recover sooner than stocks and bonds, partly because they're smaller and less liquid markets, partly because they are more risk averse, or they're seen as more risk averse investments, and they are more risk less risky than stocks and bonds. And, so I think that you could see that sides can say that they predicted it, that, yeah, gold and silver will fall with stocks, and then gold and silver will rise while stocks are licking their wounds.
So, Jeff, if we're looking at the gold stocks then, compared to gold, not compared to the US markets, but simply compared to gold, the gold stocks have been outperforming in the last about 2 months here. But quite frankly, in the January, just a couple months ago, really at the start of January, the gold stocks were underperforming gold so much so that we had only seen it a couple times in the last about 10 years. Now, again, they have rebounded, but you can still make an argument that GDX to gold has been in a downtrend since late 2020. Now, maybe this is a rebound move. Maybe this is the start of a longer term move where the gold stocks play some catch up to gold. How do you view the relationship between those two? And again, the underperformance of gold stocks broadly since 2020.
I think, our view is that we don't necessarily see this as the beginning of a long rebound of gold share prices relative to gold. We think that gold will continue to outperform gold shares, and gold shares will continue to underperform for a variety of reasons. And one of the reasons is that in a bear market, gold shares tend to behave more like shares than gold, and investors will shun them. Our view is that this decoupling, if you will, from 2020 onward, and we actually think the decoupling started earlier than 2020. It reflects a shift away from investing in individual stocks in general, as well as a shift away from investing in gold shares and mining shares. With the rise of ETFs and indexed funds and gold and silver ETFs, a lot of investors have said, given the financial underperformance of mining shares relative to the metals, I'll just go with ETFs on the metals or the metals themselves. So there's some level of disenchantment with the mining industry's overall performance on the long run financially. Operationally, they're doing very well, but financially, they're not doing so well. And there's some disenchantment with the mining industry, but there's also this very broad shift in the way equity markets work that I think will cause mining shares to continue to underperform relative to gold and silver, simply because investors are sort of shifting away from individual stock purchases.
Well, Jeff, let's also circle back to silver again. We continue to get a lot of questions about silver, especially the price performance expectations as we are now back over $33 on the futures market. We still have people coming out of the woodwork saying, hey, the $50 all-time highs are in the crosshairs now, the 1980 and 2011 high. Other people calling even for triple-digit silver over the next couple of years. Are those just pie in the sky numbers? Do you think there's any chance we get back to $50? How are you looking at silver?
I think $50 is reasonable to expect if you understand what it is. And I think triple digit numbers are totally unrealistic, pie in the sky. I don't know anything about mine production, secondary recovery, fabrication demand, or investment demand. Therefore, I can say that silver is going to go to 75 or 100 or $750 an ounce. But focusing on the 50, silver almost touched 50 for 5 minutes in 1980. It touched almost 50 for 20 minutes in 2011. And do I think that silver could rise in a spike up to $50 for 5 to 20 minutes? Yes. In fact, I wouldn't be surprised to see that at the end of April this year. It's possible. It can't stay there, though. It didn't stay there either of those times. The average price in 1980 was something like $21 an ounce. The average price in 2011 was something like $34 or $35 an ounce. So I do think that silver can spike to 50. It could probably even spike higher than 50 because it's starting at perhaps a higher base. when it made that move in April of 2011, it started April at $35 an ounce and got up to 49 something at the end of April, and then was $32 within a week. Within the first week of May, silver had fallen back to $32. And that kind of price behavior is quite possible again this April, next month. But it's important to understand that $50 is fundamentally unsustainable given supply demand realities. The cost of mining production, the cost of secondary recovery, the availability of old jewelry and silverware to be melted down at $50 an ounce, the fact that fabricators cut back sharply on their silver purchases at $50 an ounce. All of those fundamentals to the silver market preclude the price staying that high or moving higher. And some investors understand that. Most investors, I think, understand that, which is one of the reasons why when you see $50, you see any number of investors selling their metal or buying puts. But there are some people who just don't understand the fundamental mechanics of silver supply and demand. And they rely on misinformation from ill-informed promoters for their decision making, and they lose money.
So those other times that silver spiked to $50, as you said, it was very short-lived. Do investors need to be worried in a sense if they are loaded up in precious metals that if silver does spike to $50 or even higher and it immediately reverses like it has those other couple times in history, that it could be a top, whether it's a short-term or a long-term top for the precious metals, because that is what happened, especially in 2011 when silver made that run to $50?
Absolutely. We've been advising our clients not necessarily to sell their gold or silver if they see that kind of spike, but to buy a put and pay for it with a call spread so that they can capitalize those gains. And if you have a replay of 2011, the price goes to $50 and you buy a $30 or a $35 put, and the price goes to $32 within 5 or 6 trading days, the way it did in 2011, you can sell that put back at a really nice profit and lower your effective acquisition price if that's the way you want to account for your silver. You can pick up more than $10 an ounce by hedging your long position while retaining ownership of your long position. So I think that investors should be wary of that, and they should be aware of the history. And from what we've seen, just as recently as October, when the price got up to $35, the main reason why it stopped at $35 at the end of October was that any number of investors said, okay, I bought at 30, I bought at 28, I bought at 22, I'm going to take my profits. And they either sold their physical metal. We saw a wave of silver sales at $32 to $35 an ounce physical silver, or they bought puts.
Yeah, it's a smart strategy to use the options as a way of hedging. So definitely something to keep tabs on. If we see one of those spikes up, maybe a good strategy to deploy. Just a real quick question on platinum and palladium. I know longer term, Jeff, you've mentioned you're not very bullish. You expect a slow decline, but in the year to come, if we saw a continued move higher in gold, if silver was to blast up into the higher 30s or even the 40s, what do you think that does to the platinum group and palladium, those things like that?
I'm afraid it doesn't do much. I think that a lot of investors who formerly speculated in platinum and palladium now see platinum and palladium as quite different from gold and silver. And they see platinum and palladium as indicative of trends in the auto industry. And, frankly, if you see the gold and silver prices rise, it's probably because the economic environment's deteriorating. And a deteriorating economic environment usually is reflected by a sharp drop in auto production and auto sales, which means it also reflects a reduction in platinum and palladium demand for use in auto catalysts. So our view is that, you might see, you put it a different way, you may be seeing platinum and palladium supported at current low prices by the fact that gold and silver are as strong as they are. I don't necessarily see a sharp increase in platinum and palladium as a tag along to gold and silver.
Okay. Jeff, we've gone all over these precious metals. Thank you very much for sharing with us some of your research and what you're seeing in terms of the precious metals movement. Again, precious metals, I think, continuing to stand out from the broad averages, as we are definitely in correction territory for these broad averages. And, well, a couple days, the metals have gotten hit. Overall, they are, it seems like, consolidating at these higher levels and still managing to put in some very good days in the face of a lot of red that I'm seeing on my screen. Again, Jeff Christian, managing partner at the CPM Group. I will post a link to the CPM Group website in the show notes. So, everyone, please click on that link and follow along with Jeff and his research. Jeff, thanks so much for your time today. I hope you have a great rest of your week.
Always a pleasure.